Lance,
Hey,
how are you
Glenn.
this morning?
Good.
Get some new ones.
Are we ready to go? Okay. Good morning, everyone. I'd like to welcome everyone to the July 16th, 2012 Assessment Appeals Board, Tulare County. Today, sitting on our panel is Glenn Fowler, William McKinley, and myself, George Azunian. We've got a relatively short agenda today. Lance Morris is going to be sitting in as an alternate one, in case that someone on the board can't hear a case. He'll be coming in. So I'd like to start off by asking the board members if anybody has any comment. And staff. And assessors' comments. Agenda item number 2 is we're going to hear an annual assessment from Mr. Hill. And good morning, Mr. Hill.
Good morning, Mr. Chairman. How are you?
Okay.
Fellow board members, council, staff, good morning.
Morning.
Here we are on the third Monday of July and our statutory meeting under the Revenue and Tax Code. We're supposed to meet every third Monday of July to equalize the tax roll, kind of an old antique verbiage, but it gives us a chance to start the year off, and I'll present some information to you and hopefully answer any questions that you might have. I'm first going to ask a brief question. Lisa, how does this raise up a little bit? Well, I was thinking this thing kind of raises up, but anyway, I'll just stoop. That's all right. I'll hand some things out here. This is just our official affidavit for the delivering of the 2012-13 tax roll year. Some brief recap of this. We delivered this on June 22nd. We have, of course, a July 1st deadline. We delivered it on June 22nd. This is I don't know how many tax rolls. I mean, the county started in 1852, so I wasn't around back then, so I don't know what the procedure was back then. But the bottom line is that you can read through this. There are a lot of numbers. Page 1 is actually a recap of the preliminary assessed values for this year. The bottom line is we have a net tax roll of $26,620 million. It's a negative growth from the previous year. It's relatively flat, but it's down just shy of 0.7%, not quite 1%. From the previous year, and this is the third year out of 4 years that we've had a negative growth on our tax roll. So, from the standpoint of general fund revenues to the county, it's not necessarily good news. But it's consistent with what we're finding with real estate values throughout the county. When you review this, you'll see that we have a little over 173,000 total assessments, little over 150,000 secured parcels, and then a little over 23,000 of unsecured. There was some interesting percentages, declines, and even an increase. Some of our communities, Woodlake was up a little bit. The city of Woodlake showed a positive tax roll growth of just shy of 0.3%, not much of a growth. But then it started with Lindsay at being a 0.4 negative, and then it went from there to the city of Visalia showed the actual largest decline at a little over 3% decline. An interesting thing to note is that we understand, we see from the information that we have in our office that the agricultural industry is strong. We had an increase in ag preserve valuations, and so the county overall, the county outside assessment increased nearly 2.5%. And so, you know, and we had an overall negative tax roll of 0.7%, but that was supported by a strong ag economy and the agricultural industry. And so we did have an assessment outside of the cities of almost 2.5%. So the decline is certainly a manifestation of the real estate values that continue to decline. Our Prop 8, our automated review program, is still, unfortunately, for everyone, including the property owners, showing that we are in a continual decline. We added to those that we are under the automated review. We added to those. We have a total now of over 49,500 parcels that are receiving a reduced assessment in our automated program. We reviewed over 68,000 with 49,594 receiving an automated review. And we have around 1,000 that aren't in that review, and so we have, you know, roughly right at a third of our county, of our parcels, are under some type of Prop 8 review. It's kind of scary. Means a heck of a lot of work for our staff, because these are items that need to be addressed every year. They just don't sit there like those properties that are under the Prop 13 regulations. There are some good news, you know, to give you. You know, in 2008, we had over 3,800 assessment appeals. It dropped down to 1,600 for 9 and 10, and then 10 and 11 it went to 1,300. Last year, I understand we were a little over 600. I don't want you to take this the wrong way, but we would love to put you out of business. We would love to have your board not having any activity or any work. That would be an ideal situation. It won't happen, because, I mean, it's we will have situations where we have to have, and we need the Assessment Appeals Board. But this year we're looking for that 605 to drop down to something around 300. Huh, Mr. Kokendorfer? Wouldn't that be nice?
Preferable.
Yeah. So, not sure if there's any other information I can impart that you would find interesting. Overall, I think things are pretty well consistent throughout the state. Most counties that I've seen that have posted their numbers are in negative territory. Interestingly enough, there are some, you know, the county of Kern posted a 7% increase, but I think that's something called oil. And they have that petroleum roll that just is amazing. So, but most are in the flat to negative 2 to 3% range. So, nothing unusual, nothing out of the ordinary. It's just frustrating. We'd certainly like to see a turnaround.
And how do we stack up against Fresno County?
Fresno County posted, according to Paul Dictos up there, he posted a flat roll. It was slightly negative, I think 0.4%, 0.3%. And so relatively, you know, the same. Yeah.
Any other questions from the members of the panel? What is the current status of the Williamson Act? Is that being phased out, and how's that going to affect assessments?
You know, the Williamson Act we're still continuing to participate in it from the county standpoint. It's because of AB 1265 that was passed close to 2 years ago. We participated, the county Board of Supervisors elected to participate in it. We did it for 11 and 12. We will be doing it for 12 and 13. It does sunset, I believe, in 2015. And what it does, you know, since 1972 up until about 4 years ago, the state would send the county a subvention monies, roughly around $4 million a year, to help the county pay for, being in the Williamson Act because of the reduced assessments, and it was beneficial, and it was felt that the state wanted to continue. But then the state got into their economic woes and troubles and stopped sending the subvention monies, which put the county in some severe economic strait. And the Board of Supervisors made it known that they were considering getting out. That was statewide, and so Assembly Bill 1265 was passed, which allowed the counties to enact basically a special tax. And so now there is a tax, an additional assessment placed on properties that are in the Williamson Act. And so what it did, it passed off the burden or responsibility of paying that subvention funding from the state to the property owner. I didn't bring any information on that. It is interesting. We have it on our website and for 11 and 12, and we will have it soon for the 12-13, that actually gives on a parcel by parcel basis the amount of the additional assessment. Most of the time it's very small. It's based on a calculation between the difference of what the assessment would be if it were not under the ag preserve and the value that it is under the preserve. So we are. I don't believe they're taking any new contracts, though.
Very good. Any other questions? Mr. Hill, thank you very much.
Thank you.
Okay, moving on to agenda item number 3, Land O'Lakes, Inc. This is a stipulation, and if the applicant is present, applicant is not present, then the assessor, if you wouldn't mind giving us a overview of the stipulation and what the circumstances were, and then present the stipulation.
Mr. Chairman, currently Chrissy's been handling this particular case over the last several months, so if you give her just a second,
Okay.
bring her in and then have her speak to.
You want us to move on and then come back to it, or should we just wait?
Please.
Please, if we could trail that. Oh, here she is.
Okay, so can we go ahead and move forward then?
Yes.
All right.
Okay, for the assessee Land O'Lakes, the address, 400 South M Street, Tulare, California, 93274, application number 2011-00089, assessment number 176-015-003-000, for land, $526,173, structural improvements, $9,871,684. Fixed improvements, $122,883,070. Personal property, $11,535,846. The net taxable value, $144,816,773.
Okay. And what was the nature of the case to begin with?
Land O'Lakes had a cheese factory section of their property, and that's where this location happens to be. And that has been closed down, so the equipment's no longer in use, and basically they're waiting to dispose of it. They're looking at contracts right now to have it removed from the property. So.
Very good. Any other questions from the board members, panel members?
The Land O'Lakes has agreed to this stipulation, is this right?
Yes, I have.
Okay, we have a stipulation. Do I hear a motion to accept the stipulation presented by the assessor?
I'll make a motion.
Go ahead.
Have a motion. Do we have a second? Have a motion and a second by Mr. Fowler and Mr. McKinley All in favor of accepting the stipulation indicate by saying aye. Aye. All opposed, and stipulation is accepted. Very good. Agenda item number 4, Henderson Prospect Partners is, this one is also postponed, I understand. Is the applicant here by any chance?
Chairman, we've gone ahead and spoken to the applicant and agreed to, I believe, resolve the case, but in order to ensure, we're going to give ourselves a short period of time until the next hearing to get this resolved, and he was okay with not being here and let us,
Okay, so you want to postpone it until the August meeting?
please.
And that is scheduled for when? August?
October.
October meeting?
October.
Oh, October. It's scheduled for October. And what is that date, the 14th? Okay. Do I hear a motion to postpone until October 14th?
I move that we postpone item number 4 on our agenda until October, what?
14th.
14th, as requested by the assessor.
Have a second?
I'll second that.
Have a motion and a second. All in favor signify by saying aye. Aye. All opposed, motion carries. Okay, moving on to agenda item number 5, Viscamar. Is the applicant here?
Mr. Chairman, we actually have two applicants here. We have Mr. McGoffin for Viscamar. We also have Mr. George's son here. I believe it would be a prudent use of our time to hear Mr. George's first because the issue can be solved very quickly, and the Viscamar issue may take actually some time to discuss this morning.
Okay.
Rather than have Mr. George sit around for half.
That'd be fine. Is there any other items that fall in that category of being able to be processed quickly, or the rest of them are routine?
The rest of them should be routine.
Okay. Regarding agenda item number 6, the George family is a client of mine, and I'm going to have to recuse myself, but in effect, if you wouldn't mind coming forward, and I'd like to hand the meeting over to Mr. McKinley, and go ahead.
And she'll go on as the alternate at this point. George,
Good morning.
good morning.
I'm just representing my father. He's ill today. And I've met with Mr. Bradford, and we've decided to mutually agree to postpone until September, if that's all right. They wanted some more information that I wasn't aware.
I'll make a motion to postpone it to the October, is that correct, 14th meeting?
September or October?
September's good for us.
Okay, till
Should be
September.
September 17th.
Okay, September 17th.
Second.
I'll second that.
Signify by saying aye.
Aye.
No? Motion is carried. Thank you very much.
Okay, thank you very much.
Mr. McKinley,
Thank
before
you.
he leaves, just to point out, he may actually need to sign a 2-year waiver on this one since his application was filed in August of 10. So if we're going to postpone until October, maybe need to have Mr. George see the clerk to arrange that first.
We're going to postpone until September. Does that make a difference to you?
Still need to file that 2-year waiver.
Thank you.
Okay, that takes care of agenda item number 6. Back to agenda item number 5. Viscamar, is the applicant present? At this time, have the clerk swear in the applicant and the assessor. Okay, if you wouldn't mind giving us a summary of your application.
The subject property is the Marriott Visalia at 300 South Court Street, and the assessment appeal was filed based on income analysis, looking at revenue and what the value should be as of January 109.
I'm sorry, would you name the property again, please?
Pardon me, sir?
Tell me what the property is again.
It's the Marriott Visalia Hotel at 300 South Court Street.
Often, if you have a presentation, you'll need to pass it to the clerk so she can pass it to the board members.
Action. I think you've got two sets. Two copies. One should probably go to the assessor, although you have all of this already, Tim. Actually, he doesn't.
I think that's yes.
Go ahead. I'm sorry.
Oh, all right, I was just waiting for you to go through it. If I could direct your attention to this document. This is the actual year-end 2008 operating statement for the Visalia Marriott facility. It has previously been provided to the assessor's office. The categories are down the middle of the page. To the left is the monthly information for December of 2008, and to the right is the year-end, year-to-date information. And if I would ask you to focus on the right side, since it does take into consideration the 12 months of the calendar year. On the right side, the far right column is the 2007 actual income information, income and expense information. And if you move 3 columns to the left, you have the actual for 2008. And on the first page, if you go down about a quarter of the way, you'll see that total revenue, if you go to the far right, in 2007 was $6,536,000, and total revenue in 2008 was $7,058,000. A little bit of an increase, but relatively the same. And you can go down the rest of the expense items as they are indicated there. I'm not going to read every one to you. It's very self-explanatory, but I would ask you if you would go to page 2 of that report. Page 1 and page 2 are a recap of the pages that you have behind it. The pages that you have behind it show additional detailed information for the information contained in the recap on page 1 and 2. And if you look on page 2, you'll see again about a quarter of the way down net operating income. And it shows net operating income for actual 2008 of $1,125,194. Now that does include real estate taxes as an expense. It does not include, as you continue down that page, the next item you'll see is the annual rental income. That's like a cell antenna income. And if you go a little further down the page, you'll notice almost on the bottom where they have two lease expense items. This facility, as you know, is next to the convention center, and they do rent and lease space from the convention center. If they have additional space that they need to utilize, they need to lease that from the convention center and pay for that. And the point of all this is that in looking at an income capitalization approach to value, when you look at the income stream generated by a lodging facility, what you're trying to do is ascertain the income that is generated due to the investment in the real estate and the property and plant and equipment itself, and take out those items from the income stream that do not support that, so that you arrive at a net income number that we can use then for capitalization purposes. And I'm sure you've seen income approaches to value on other properties, and it's the same methodology or similar methodology. If you go to the second page of the other handout that I have given you, you'll see that that's a one-page recap of the actual 2008 income and expense information. And this is looking at the document that I previously alluded to, and trying to arrive at a net income number to the real and personal property. And that, again, is net income before debt service, depreciation, amortization, income taxes, and property taxes, but allowing for all of the expenses that the income incurs, and in addition to that, allowing for a reserve for replacement, which is the last item you'll see on the second page of the handout that I'm referring to, the $284,185. Lodging facilities are a little different than other investments in real estate, such as a shopping center, an apartment building, or an office building, where you have a very intensive investment in furniture, fixtures, and equipment. In order to replenish the furniture, fixtures, and equipment, because they don't last like the building does over a 30 or 40-year period, Marriott does require, and this is a Marriott franchise property, does require that you set aside funds from your yearly operations to provide a reserve for the replacements of personal property. In looking at that, it's as we look to real estate for a return on and of your investment, so too with personal property, you're entitled to a return on and of. So what we're trying to do here is take out from the income stream the items that are necessary to be deducted prior to determining that number that should be used for capitalization purposes. And in this instance, in so doing that, the number that I came to for 2008 was $815,938. We are looking at value for this property as of January 1 of 2009. That is the year in question. The economies were in place in 2008 that were such that as you're looking at this property in early 2009 and 2008, you know that the economic downturn had happened, that if you look at monthly ADR and occupancy, ADR is average daily rate, and the occupancy ratio is the number of rooms that you sell for a lodging facility on a daily basis, and you compare it to a prior year, the trend was downward at this point in time. Based on that, the first page of the handout that you had, I did a pro forma income statement, and that is this page.
Yes.
And based on that, I took the number of rooms times an average daily rate times an occupancy ratio to arrive at potential room revenue of $4,862,676. I then added back to that food, beverage, banquet, and other income to arrive at a projected total revenue of $6,565,676. In looking at the prior 2 years, 2007 and 2008, and knowing what was happening in the economy in early 2009, it was my opinion that at that time, if you were sitting at that time looking at projecting what the revenue for this facility is going to be in the upcoming year, that it was going to be a downward trend, as was the economy was indicating at that time. But I didn't think that it would get to a number that would have been less than the revenue generated in 2007, hopefully. So I projected revenue at $6,565,676. In order to capitalize or to find a net income number, we have to allow for expenses. If you, again, looking at the 2007 and 2008, the expenses, or the net income after expenses were running about 12%, which would mean expenses were about 78%. In addition to that, I looked at national statistics, which you'll find on the third page of your handout, and it's a page that looks like this. And that is from the PKF Hospitality Research for year-end 2008. And if you look at the far right column, you'll see that the trend statistics in the lodging industry, and this is for full-service hotels, and if you go down to the net operating income number, it's 17.3%. I took that 17.3%, and if you go back to page 1, on the bottom, it shows you the 17.3% from the report. I deducted from that a reserve for replacement at 4%, which is typical for a Marriott property. I added to that an adjustment for the Marriott management fee. If you look at the report, it showed a management fee of 2.5%. Marriott's management fee is typically in excess of 5%. But it also deducted real estate taxes, so I adjusted for the 1.1% real estate tax rate that you have here to arrive at 11.9. So that's where my 11.9 percentage for net operating income came from. I then took that times the total revenue projected to arrive at a net income to real and personal property on page 1 of $781,315. In looking at capitalization rates, if you look at the fourth page of the handout that I've given you, and that's a page that looks like this. Very simply, that is a compilation of full-service hotels, capitalization rates in 2008 and the first quarter of 2009. And you can see that they show average and low and high, and that the rates vary. In looking at that, I felt that this being a Marriott property, if you go back to page 1, that an 8% rate was appropriate. I then took the net income of $781,315 and used an 8% cap rate to arrive at a total property value of $9,766,438. I then deducted from that the assessment for personal property as of January 109 of $2,927,187 to arrive at an indicated real property value of $6,839,251.
Does that conclude your presentation?
Yes, sir.
Okay. At this time, we'll let the assessor make their presentation. Typically, what we'll do is we'll have one round of readdress after we hear the assessor's presentation, and then concluding remarks, and then we'll adjourn and see where we are. Mr. Assessor?
Madam Clerk? Mr. Chairman, when reviewing this particular property, we likewise looked at the income, but additionally we decided to look at all three approaches to value and use a reconciliation in order to determine the current market value. In approaching it with the cost approach, we used that one first within our presentation, and going through we used a nationally recognized cost manual and used a very liberal percentage of depreciation to depreciate the structure, based on the fact that the Marriott had a rehab in 2006 at the tune of about $8.3 million. With that, we came up with the value of about $19 million for the replacement cost on the property. We then went through and looked at comparable sales from the local market. The comparable sales that we used are all within about a 20-mile radius of the subject, and all sold within a reasonable time period before the valuation date. In looking at the comparable sales, we chose not to do adjustments. The only comparable sales that were available to us were ones of inferior limited service hotels. The Marriott is the only full-service hotel here in our county. In looking at those sales, even with an unadjusted approach, not adjusting for physical differences in room number, size, location, and similar differences, we were able to come up with a value of $16 million on the property. We thirdly looked at the income approach and did much like Mr. McLaughlin, went through and analyzed income and expense statements that they presented to us. We used the direct net operating income provided by Mr. McLaughlin and the Marriott to go through and determine a value using that approach of about $11.5 million. Property is currently assessed at about $10.5 million. So with such a wide range of value, anywhere from $11.5 to $19 million, we went back to start to look at reconciling those three approaches to determine which one would be applicable valuation. In looking at it, we decided to put the most weight on the income approach to value. The argument that Mr. McLaughlin is offering to you this morning is slightly less than ours. And in that case, oftentimes when you have such a great disparity between two arguments, I think it's best to go back and use different approaches to reconcile it. In this particular case, we went and used the market approach to ensure that the income approach that we were attempting to use was accurate, or at least within the market range. Using those unadjusted sales from our local market, which were inferior limited service comparables, we came up with a value range of about $9.9 million to about $21 million, depending on which comparable you use. And that's based on a range of about $51,000 a room to $112,000. The value that Mr. McLaughlin is presenting to you today is actually outside of the range of value using the local comparable sales. So oftentimes when you're reconciling and something falls outside of the range where buyers and sellers are involved in the market, are doing these exchanges, there may potentially be an issue with the approach that he's using. I'm looking at the net operating income, and it seems to be slightly lower than what he offered us in the expense, the profit and loss expense report that he has given us. With the income approach then that he's offering being outside of it, I think that we might want to look at some of the variances there and certainly look at the local sales that are applicable to this particular property. The assessor's office is advocating nothing more than leaving the assessment currently where it stands at the $10.5 million. In looking at the sales, I think it would be very clear based on the images provided to you and the numbers that you see in front of you that they are inferior limited service comparables. The analysis that we did of their income can be found in Exhibit A. There are several other exhibits in there that support our rate. We chose with the income approach to value to go through and use what we believe to be a reasonable local rate based on the range of value that is given by a national publication that gives us a range to pick from. Net operating income difference, though, between the two approaches, while Mr. McLaughlin comes up with a net operating income of $815, ours has come in at $1.2 million. We've used all of their departmental expenses, all of their unallocated expenses, and all the property charges reported on their profit and loss statement. Additionally, we have added back in, just like Mr. McLaughlin, the property tax component because it was taken out inappropriately in the profit and loss statement. The overall capitalization rate we chose was only 1% higher, including the tax rate, than what Mr. McLaughlin has presented to you today. So there's not much variation in even those two approaches. The primary difference where we come in with a lack of agreement are on the actual expenses. Mr. McLaughlin is reporting to you that there's some lease contract expense with the Visalia Convention Center that should be included as an expense. And our understanding after talking to the general manager this week that the arrangement is merely a pass-through expense to their guests. They do a service of booking space in Visalia Convention Center for their guests and directly charge them to it. So they're not actually accruing an expense with this particular service. Because the Visalia Convention Center is maintained by a separate entity and managed, claiming an expense on that side we believe is an invalid approach. I cannot claim that someone else's expenses, say Mrs. Langley's on my tax return, are mine and then use that to reduce my income. And that's generally the approach that's being service. The rest of the expenses, though, are directly taken from the profit and loss statement provided to us. If you review the profit and loss statement provided by Mr. McLaughlin this morning, and you review page 14 of our presentation, you will see each one of those numbers directly reflects what was given us to work with. We believe that the basis of our argument, while the income approach usually is the preferred method, and we have leaned upon it because of its lower end evaluation, that we always have to look back to the actions in the market that would support that valuation derived by a method that has so many variables and contingencies in it that the range of value you can come up with it is very broad. So we've used the market approach to guide us in choosing the income approach and showing its validity because it does reflect what the people are doing in our active local market.
You're using a capitalization rate of 9, is that correct?
That is correct, Mr. Chairman.
Any other questions by the board
I had a
members?
question. What was the original acquisition price of this property?
Original acquisition price was $15 million, and
15
then,
million, what date was that?
I believe, sir, that was in 2005, but I will confirm.
2005 was $15 million, and they put a $8.3 million additional remodel into the property?
That is correct.
All right.
Mr. McKinley, any questions?
A lot of information here to digest, and I'm not sure I've got it all digested. I want to go again to the difference between the income statements that the two of you have presented. Can you go down it line by line what the difference is for me? Either one of you, I could care less.
I believe that the difference is twofold. The assessor, as he indicated, did not allow for the additional expense of leasing additional space in the convention center. And he is right that the convention center expense is supposed to be a pass-through to the people who come and they want to have their banquets and their meetings and that. So and we, in our revenue, include that income. But we have to also allow for that expense. That is an additional expense that we have to pay to lease additional space from the convention center to accommodate larger groups.
Mr. McLaughlin, can you point out to me in the profit and loss statement
It's on the second page.
where the income generated by that expense is?
The income generated is in the food and beverage areas.
Funny, because, Mr. McLaughlin, I'm looking at a copy of the general ledger for 2008 of the Marriott. They never in here reference income in the food and beverage section from this expense. So if these numbers, and they do, correlate with what's been provided in the profit and loss, that would mean that the income is not reflected in that food and beverage number.
Well, the income is, when you have people that come in and they want to put on a convention, they require meeting space. And they'll bring you a group and they want a block of, 100 rooms. So you contract with them and you agree on a certain price per room. The expenses that you incur in terms of providing the meeting space correlates to that revenue that you receive in the rooms area. It's not necessarily a specific charge for, here's your meeting room expense, here's your room expense. It's kind of all tied together. It gets jumbled.
Wouldn't it be reflected then in the room expense and not the food and beverages you just said?
Well, it kind of gets reflected in both places because they do banquets, they do weddings, stuff like that, and those, that revenue will be in food and beverage.
Can you explain to me then why in the general ledger they don't specifically draw that out? They do draw out the leasing expense?
That I cannot explain to you, no.
So are you completely sure then that that revenue is included in those numbers?
I believe it is, yes.
Just to be fair to the applicant, let him finish addressing the question that Mr. McKinley brought up, and then we'll go ahead and let you restate your cross-examination of his testimony. So if you'd like to complete your rebuttal.
That there were 2 points and you've covered one.
Yes, the other one is the reserve for replacement. If you look on the income statement, they do not make an allowance for that on this statement. However, There is an adjustment that needs to be made from the income stream to provide for the replacement of the furniture, fixtures, and equipment, because again, it doesn't last 30 years like, I mean, nobody wants to sleep on a mattress that's 30 years old. To provide for the eventual refurbishments. And I have provided Tim with some information concerning the balances in the reserve replacement account on a yearly basis.
Are these statements audited?
Yes. I'm not sure who the independent auditor is for the company, but they are audited, yes.
These are direct copy off of the audit, the statements here.
Yes, sir.
Generally speaking, depreciation is not considered in determining the value of a piece of property.
I agree with you. I'm not talking about depreciation.
Explain to me the difference between your, whatever this, replacement reserve and depreciation.
You have to have a fund of money available to you over, say, 7 years. Personal property on an average in a Marriott hotel will be replaced once every 7 years. And I used to work at Marriott Hotel Corporation, and when I did, we had Marshall and Stevens do studies on the length that the FF&E lasted, and it came out to an average of about 7 years. In order to provide the money in that 7th year when you have to replace it, you have to allow for like a sinking fund type investment where you set this money aside, but that has to come out of the actual operations of the property. That's not money that comes from someplace else. I mean, technically, this is an investment, and it's supposed to pay for itself over a long-haul period of time. Marriott requires in their management agreements and their franchise agreements that a reserve be set aside out of yearly revenue for this eventual replacement of property, and it's not a depreciation expense.
Why is market value determined by a Marriott rule?
Market value is not determined by a Marriott rule, but if you are looking at a Marriott property, you have to, if you want the Marriott flag, you have to participate in their system. And all lodging facilities will have a similar type of reserve. I mean, this is very common in the lodging industry. If you look at the books that are put out by the American Institute of Real Estate Appraisers and the Assessors Group on how to value hotels and motels, it requires that a percentage on a yearly basis be taken out of the income stream to account for this.
Have anything to point out to me that the history of this hotel is to put in 7% a year, or
It's more like 3 or 4. It's more like 4%. I do have what I supplied to Mr. Kokendoffer, and I probably included his last name.
Very close.
To murdering it or to saying it?
It's actually nailing it, which...
I don't have a copy, but I can show you this.
just explain it to me.
This is a general ledger detail report. Actually, it goes through 2008, 9, 10, and 11. And it shows the FF&E reserve account balances as of year end, if you'd like to see it.
Okay, no, that's fine. I'm like to address it to you, Tim. Why are we using estimated numbers for 2009 instead of actual numbers?
And we are actually using actual numbers. If you...
I thought, my understanding here is that we're doing this based on the number of rooms, the average rate, the occupancy, so on and so forth.
That is what I did, sir. That wasn't what the assessor.
The applicants.
The assessor's office approached it using the profit and loss statement. We took directly off of here the numbers for the revenues generated and the expenses.
And to you, why are you using estimated numbers rather than the actual numbers?
When you're sitting at a specific point in time, we're talking about values of January 1. That's what you're going to use to value the property over the next 12-month period. And there are two ways of doing it. You can either look at the year just past, or you can project the year coming up.
But by now, you should have the 2009 figures.
Well, I do have the 2009 figures by now.
Are they substantially the same as what you've estimated?
2009. Total revenue was $6,354,061.
It was
Actually, a
$100,000 more.
little lower than what I estimated, yes.
What was the
Say it
net
again?
operating income?
Higher.
Pardon me?
What was the net operating income for 2009?
For 2009, the net operating income was $823,525. I have copies of this if you like it. This
Well,
is-
I think that basically we're looking at 2008 for the appeal, correct?
But
But I think what the board is looking for is a trend back and forward.
To answer your question, the net operating income, not including the additional expenses for the leased space that they have to pay, and not including reserve replacement number, was $823,525. So it had gone down.
Counsel, in using the income approach on this particular situation, which year should we be using for the income?
I'm gonna have to look at the rules on that and see.
Can you give me any help?
The assessor have.
As I've indicated, there are two ways. You can use the actual year that just passed. However, when you're sitting at that point in time, you're trying to project what the value is going to be for the next coming year, for the next assessment cycle, for the next fiscal year that you're going to pay your taxes on. If you're sitting in January 1 of '09, and as we know, you're not supposed to look past April 1 of '09, the economy had drastically changed at that point in time, and everything was on a downward trend in terms of value and in terms of the lodging industry, in terms of average daily rate and occupancy, it was trending downward. So if you're sitting in January 1, '09, how do you not take that into consideration? I think you have to be realistic and realize that you might have earned this amount of revenue in the prior year, but it's not going to be there the next year.
So you're saying that the traditional definition of a buyer, knowledgeable buyer and so forth.
Right, a
Would be
perspective,
affected by that trend, is that
that's
your
correct. A
argument?
prospective buyer is going to make his determination whether or not to purchase based on his future operations, not on what's happened in the past.
Is
Mrs.
this
Klotz?
property valued strictly because it has a Marriott franchise, or is it valued on its own basis?
Well, it's a little bit of both. When you look at valuing a lodging facility and you go through the income approach to value, you take out of the income stream the expenses that you incur in order to maintain that franchise, whether it's a Marriott or Holiday Inn or a Super 8 or a Motel 6. The Marriott franchise fees are typically going to be higher than, say, a Motel 6. So that, yes, you do take that into consideration.
What I'm trying to get at is that this property would have a value, obviously, if it was not a Marriott.
Yes, it would.
Would that be anywhere different than where it is as a Marriott?
I believe so, depending on the franchise. If it were unflagged and an independent property, it would not have the value that it has as a Marriott. No, if it were a Motel 6, you wouldn't be able to get $100 a night in a Motel 6.
That's not even a reason.
No, I realize that, but that's my point. There's a range here. Marriott's at the top of the range, and there is somebody else at the bottom, and there's everybody in between. If it were a Holiday Inn, it would probably not generate the higher ADR that a Marriott does.
Okay?
Mr. McKinley, to answer your question, I think he kind of answered it. You can take both approaches. You can take a hypothetical, or you can take the actual values.
Mrs. Klotz, does that come directly from Rule 8?
Yeah, the Rule 8, the income approach to value is used in conjunction with other approaches when the property under appraisal is typically purchased in anticipation of a money income, or either has established income stream or can be attributed to a real or hypothetical income stream. So you can attribute it to a real income stream or the hypothetical that he proposed.
Fowler?
Yeah, I had a question. How did you arrive at the 8% on here?
I looked
Capitalization
at.
rate was based on what?
I looked at some of the national statistics from other lodging facilities or reporting services such as PKF.
This is the direct capitalization that
Yes,
you
sir.
utilized on the back?
Yes, sir, and that's for full-service hotels, and you'll see that there's quite a range.
Yeah, that's why, where did you come up with the 8% out of that then?
Well, I did want to look at necessarily the higher end of the range because this is a Marriott property, and Marriott typically has a better income stream supposedly. It's better quality, we can put it that way. And I felt that 8% kind of threw out the high end and was more in the range of where the
It's an average,
average and low was coming out. I
took an
guess.
average on the income that, you didn't go to the market to assume the 8% then.
No, sir, I didn't. And as Mr. Kochen-Darfer has told you, he did not have any full-service lodging facility sales information. The information he had was from limited service properties. Limited service properties typically are not as intensive in expenses as a full-service, and again, this is a convention center facility is, so that it's going to be a little different. Also in 2008, and I don't remember the dates of his sales, but I'm sure they were from 2008 or prior. Actually, one was in 2007, one was in July of 2008, one in January of 2008. Going from, his most recent sale was July of 2008, and the oldest was in August of 2007. During that period of time, everybody was still seeing rosy futures. Banks were still lending money based on anticipation of revenue that didn't generate. So that, you know, I don't think it's reasonable or fair to look at these types of properties. And my gut is today that probably one or two of them have been taken back by the bank. So that I don't feel that that's a reliable way to look at these properties as to what something else sold. If you're an investor in a lodging facility, you're buying an income stream. And based on that income stream, you have so much money that available to you to pay for your operating expenses, your property taxes, your debt service, and you want a return on your investment. So all of those things have to be there. And this is a different type of property. It's even different than a full-service facility because it's a convention-type facility. It has higher operating expenses. I mean, a lot of the meeting space that they use, they make the food in the Marriott and then got to cart it over there. So that requires, you know, a more intensive investment in plant and equipment or in personnel and expenses.
So this 8% is the hypothetical figure, is that
Yes, sir.
correct?
As is the assessor's 9%. I mean, he did the same thing. He looked at the same type of statistics and came up with 9%.
Additionally, though, if you'll, Appendix D in your presentation from the assessor's office are local sales that we have used during the 2009 year to help guide us in the choice of our rate. What you'll find in there are some highlighted blocks in the bottom showing confirmed sales in 2009, where the rate ranges from 4 to 8% drive locally. We chose to also incorporate the PricewaterhouseCoopers study that gets done nationally, and their range rate for rates was anywhere from 6 to 14%. So when we went through and used our cap rate, we developed one that is really kind of a combination of the local rates that we derive from sales and then what we were getting nationally as well. And we likewise went up on the high end.
Marriott paid $15 million for this property. Marriott, I assume, is pretty up on these properties on investments, and they paid $15 million for it. We're assessing it at $9 million. Is that correct?
10.5.
$10.5 million. And you put an additional $8 million into this property. And you're asking us to come back with an assessment of $6 million?
Well, actually, I'm
I
looking
mean,
at,
Marriott is a pretty, they know the value of property, is that not correct? They would look at this property on an income basis or whatever and establish a value then at $15 million on return on their investment. Now, and
They're
then
not getting- they're-
then they came in and put an additional $8 million in renovation remodel into this property, which now has improved the value considerably.
right.
Follow what I'm telling you?
Yeah, no, I understand. Well, that was in 2005.
Yes.
And 2005, you know, was a different economy than what we had in 2009 also. In addition to that, it was not Marriott that acquired this property. It was the LLC run by people out of Texas. So it's not a Marriott corporate property. So it wasn't Marriott Corporation that acquired it. It was somebody else investing in this type of facility. And I'm sure at that point in time, they had somebody do an appraisal for them that told them, you know, 5 years from now it'd be worth, you know, X amount of dollars, and it would generate X amount of numbers in income. And that's what people look at when they're acquiring property. What's the future benefit of having this property, what income is this thing going to generate for me, and how can I pay my debt off? Well, the net income is not there. I mean, this facility generating a 12% NOI is not, a real healthy thing. So
12%
that,
NOI based on your estimated expenses.
that's on including an allowance for reserve replacements, yes.
But I assume that they were pretty well, they would add in a figure for that, for inflation.
Well, they do.